Alright, so in this video we're going to continue our discussion of AUC section 200.19, and it says that to obtain reasonable assurance, the auditor should obtain sufficient appropriate audit evidence to reduce audit risk to an acceptably low level, and thereby enable the auditor to draw reasonable conclusions on which to base the auditor's opinion. And so in a prior video, we discussed what does sufficient appropriate audit evidence mean. And so in this video, we want to discuss and understand what exactly is audit risk. And fortunately, the AICPA has defined audit risk for us, so let's go up to the definition. Okay, so here we have the definition of audit risk, and it says it's the risk that the auditor expresses an inappropriate audit opinion when the financial statements are materially misstated, and that it's a risk, or it's a function of the risk of material misstatement and of detection risk. And so we will need to understand exactly what are the risk of material misstatement and detection risk. So let's first start out with risk of material misstatement. And so that is the risk that the financial statements are materially misstated prior to the audit. So let's dive a little deeper into what exactly that means. So we see here in some of the interpretations of GAS in AUC section 200 that the risk of material misstatement exists at two levels. The first one is at the overall financial statement level, and the second one is at the assertion level for classes of transactions, account balances, and disclosures. So let's take on each of these separately. So the first one is the overall financial statement level, and this refers to risk of material misstatement that relate pervasively to the financial statements as a whole and potentially affect many assertions. So example of this might be fraud occurring at the company or management override of controls. So in those instances, it may affect several accounts or disclosures. So it relates to the overall financial statements. So next we have the risk of material misstatement at the assertion level. And so assessing risk at this level allows us to determine the nature, timing, and extent of further audit procedures necessary. And so the risk of material misstatement at the assertion level is further composed of two components, inherent risk and control risk. And we want to make note that these are the risk within the company and have nothing to do with our risk as the auditor. And so let's go see exactly what is inherent risk and what is control risk. So first we have inherent risk at the company, and this is the susceptibility of an assertion about a class of transaction, account balance, or disclosure to a misstatement that could be material, either individually or when aggregated with other misstatements before consideration of any related controls. And so inherent risk could be higher for certain assertions or account balances for a number of reasons, one of which may be that there are complex calculations involved in coming to that account balance. For example, maybe trying to calculate the value of derivatives or some other complex calculation. It could also be due to the account balances being derived from really subjective accounting estimates. Maybe, for instance, the allowance for doubtful accounts or goodwill impairment, something like that. Or a higher inherent risk might come about from the susceptibility of a technology company's inventory being obsolete. So the inventory accounts might be have a higher inherent risk. Or it could just be related to the entity's environment or their industry. For instance, in a declining industry, maybe in the future the company might have trouble paying off its debts or its vendors or getting its receivables paid or even challenging the going concern assumption. So there's a lot of different variables here that boil into the inherent risk of different accounts and such. And so the auditor needs to use his professional judgment in determining how high or low is the inherent risk for different classes of transactions, account balances, and disclosures. So next let's take a look at the other component of risk of material misstatement at the assertion level, and that's control risk. So control risk is the risk that a misstatement that could occur in an assertion about a class of transaction, account balance, or disclosure, and that could be material, either individually or when aggregated with other misstatements, will not be prevented or detected and corrected on a timely basis by the entity's internal control. So are there internal controls in place that would detect, correct, or prevent misstatements from occurring? And so this means we need to evaluate the effectiveness of the design, implementation, and maintenance of internal control by management to address the risks that threaten organization's objective. And we can do this by inquiries with management, doing walkthroughs of the control processes with the control owners. But if we intend to rely on the controls of the company, we would need to test those controls for effectiveness. And if it does turn out that they have effective controls in place after we've tested them, we might could reduce the nature, timing, and extent of our substantive procedures. But that's generally a judgment call for the auditor to make. However, we note that control risk can never be eliminated, and that's because there are several inherent limitations to internal control, and that might be that humans generally make errors and mistakes every now and then, so they might not fulfill the control correctly or overlook some things. The controls can be circumvented by collusion, so if more than one individual within the organization agrees to not operate the control correctly, they could circumvent these controls without anyone knowing or finding out. And also there could be an inappropriate management override where the boss comes over and tells an employee to do something that's outside of the normal controls, and the employee might feel the obligation to obey that manager. So generally in the audit, we will set the control risk at maximum unless we intend to rely on the effectiveness of the controls. In that case, we would have to test them. And if it turns out that the tests were satisfactory and it looks like the controls are effective and in place, then we can reduce the control risk a bit lower. Okay, so we remember that audit risk is a function of risk material misstatement and detection risk. So here we'll take a look at detection risk because we just discussed the risk and material misstatement previously. So detection risk is the risk that the procedures performed by the auditor to reduce audit risk to an acceptably low level will not detect a misstatement that exists and that could be material either individually or when aggregated with other misstatements. So in that sense, detection risk is inversely related to the risk of material misstatement. So in that sense, the greater the risk of material misstatement that the auditor believes exists, the more procedures, and for instance, the more persuasive the audit evidence needs to be in order to reduce that detection risk to an acceptably low level to mitigate the overall audit risk, the risk that we did not detect a misstatement or that misstatements exist in the financial statements and we gave an incorrect opinion that says there aren't any. So in trying to reduce this detection risk, we need to plan and perform the nature, timing, and extent of our audit procedures in an effective and efficient manner to reduce that detection risk to a level that's manageable. And some of the key tasks in the audit that help us do that are doing adequate planning to understand where our risks are, doing proper assignment of personnel to the engagement team, so making sure that the people are educated and experienced with the areas that they're working in, the application of professional skepticism, so we make sure that we're always keeping an eye to areas that might be susceptible to misstatement, and also proper supervision or review of the audit work performed. So in that way, someone who's more experienced is overlooking the work done to make sure that we reduce this detection risk level appropriately in light of the level of risk and material misstatement that we have, particular assertions and account balances and such. So this is explained a bit more in AUC section 300 and 330, and more discussion of the risk and material misstatement is included in section 315. So overall, section 300s are very important for risk assessment and planning the audit. Okay, to sum us all up, I've got a figure here of what we just discussed, which makes it easier to see how all this is connected. So at the top we have audit risk. That's the risk that the financial statements might be materially misstated, and we say that they're not. And this audit risk is composed of both the risk and material misstatement and detection risk, or rather, the audit risk is a function of these two, and these are inversely related. So the more risk and material misstatement is, the more procedures we need to do to reduce the detection risk. And so the risk and material misstatement is composed of two levels. The first level is the overall financial statement level, and these are risks that may be pervasive to the financial statements as a whole or to several assertions. And so we also have a risk at the assertion level, and this might be classes of transactions, account balances, or disclosures. So for instance, cash, accounts receivable, etc. Would all be different assertion levels. And so this assertion level is composed of inherent risk and control risk. And inherent risk is the risk that's naturally inherent in these particular accounts or classes of transactions based on maybe how complex they are, how much subjective decision making there needs to be done in determining their values. And there's also control risk, which is the risk that the company's internal controls would not detect or prevent or correct misstatements that are in the financial statements. So that's how all this comes together.